Hello and welcome to Capital Management's weekly roundup, where the fundamental shift continues to risk-on trades away from risk aversion, where higher yielding currencies driven by inflation remain on a risk train, benefiting from higher interest rates due mainly to cost-push inflation fueled by higher commodity prices, notably the euro and commodity currencies such as the Australian and Canadian dollar, at the expense of low-yielding currencies such as the yen and currently the US dollar. There will be times, though, when the train will stop for periods of risk aversion, during which different currencies will join and others leave. Currently, due to exogenous shocks, the New Zealand dollar's recovery following the earthquake is a good example, due to a possible end to the shorter-term commodity uptrend, where the Aussie, Canada and by extension the Kiwi would reverse, or a correction in the stock markets, or fallout in the European rescue packages. This pause may prove temporary, but it's our belief that as the speed of a global economic recovery gathers, the risk train will remain firmly on the rails as interest rates continue to rise and more currencies will want to join. But it's the relative speed of interest rates that is important, and currently the dollar is being left behind. That should change soon. Indeed, last week we showed how the dollar index is following the basing pattern of the previous major low, and how this better named anti-euro index is taking out obvious supports in a C-wave wedge to an ideal final 73.28 C=A target before it reverses back through 78. This continues to support a June 2009 euro analogy that this week should produce the final long-awaited 146.30 target. Yes, this should produce a sizable reaction, but there remains four things that will help us decide whether it's the euro or the dollar that will benefit most from risk on for the rest of the year. First is the trailing stop at 142.45, although we are tempted to raise it to 143.50 now. Second is game theory, outlined last week, the double or triple whammy, which essentially comes down to whether the market is long. We think it's getting there. Third are the euro crosses. Yes, we remain bullish euro-yen for 127, at least to end the five-wave trend sequence. But sterling-yen is equally bullish, neutralizing the euro component. Euro-sterling appears to need a deeper correction to at least 87, following another attempt at 89.50. And euro-swiss looks like it will fade above 130 again for a new attack on the 124 lows. So clear warning signs. Fourth, the other dollars. Cable remains within the confines of an expanding wedge reversal formation. Dollar-yen should resume the uptrend to 88 while holding 82 the figure. And despite a likely declining wedge begging new lows on dollar-Swiss, this should reverse from the next substantial new low. So how will the dollar index go another 2%? Obviously the euro, but it should receive more support from the commodity currencies in their more aggressive blowouts. Yes, the 94.50 C=A on dollar Canada, but a chance to overextend as low as 92.70. And Aussie remains set for 107, but with an incredible possible blowout target of 110.75, our C=A objective for over a year. This should drag the Kiwi higher, yes, to 18.90, the 5=1 short-term target, but with an incredible 5=1 target in the medium term of 82.55. All on the back of a commodity blowout. And yet, oil and gold in our view are clearly topping out, having achieved our targets, and could well be vulnerable later this week to something quite dramatic. One of the reasons behind this view is the concept of currency equalization, where a rise in the dollar will see commodities fall in order to maintain their real value. Similarly, stock markets with the weakest currencies should strengthen most in the longer term, but should start a reasonable correction later this week as the risk train comes to a major junction. This is where we think the euro gets off. But to find out how and when, as it happens, join us aboard marketvisiontv.com or follow our video alerts on Capital Management or insights from Don Haynes or me, Ed Matt, on Twitter. We hope this will be a long journey and not just a brief encounter. Good luck, and of course, have a great week.
I'm so glad I had a chance to explain.